Brian, I'm curious, let's just cut straight to the chase. In 5 words or less, why multifamily? Why is multifamily the investment of choice?
Because it was what I was good at. How many words is that?
What's up, everyone? Welcome to another episode of The Remote Investor. I'm Michael Albaum, and today I'm joined by a very special guest. He's an investor, author, CEO of a vertically integrated private equity company, Brian Burke. Today, Brian's going to be talking to us about all things multifamily, what he's seeing in the space, why it's one of the best investments in his opinion, but also why he's actually pivoting away from it. So let's get into it. Brian Burke, what's going on, man? Thanks so much for coming on and hanging out with me. I really appreciate it.
Well, thanks for having me here, Michael. Sounds like this is going to be a lot of fun.
We are going to have a lot of fun. You and I were just chatting before we hit record. And if you're just listening to this, I got a big ear-to-ear grin on my face since I know this is going to be an awesome episode. So, Brian, real quick, give everybody your background, who you are, where you come from, and what is it you're doing in real estate?
Well, my background goes all the way back to 36 years ago when I started investing in real estate, kind of fresh out of high school because I had no money, no friends that did real estate, no contacts, no investors, and no knowledge. And I figured that was a complete toolkit for any real estate investor. So that might as well be where I go. So
it's the obvious choice.
It was the obvious choice. I read a book that said you can buy real estate with no money down, and I thought, well, I have no money. This sounds perfect. I think I'll do that.
Perfect.
So I started buying real estate, and I got my first property with no money down, just like the book said I could. Then I learned later that that's actually pretty rare. But I did a lot of single family fix and flip early in my career. I've done about 750 of those, and got into multifamily about, 20, 25 years ago, and really never looked back. Multifamily has been our core competency for quite a number of years. In fact, coming on multiple decades now. I've bought about 4,000 units of multifamily, sold 3/4 of that literally right before the market collapsed in second quarter of 22. And kind of been sitting around wondering what the next thing was for the last 3 years, and actually just launched our first fund in 3.5 years, buying skilled nursing facilities and assisted living and memory care. So it's been quite an interesting journey in real estate for me over the last 36 years.
Hey, what's going on, everybody? Just wanted to give a quick shout out to Bold Street, which is a prop tech company designed to be the #1 place to find and source residential real estate investments. They are going to be able to help you source, find, have access to exclusive off-market properties that you aren't going to find anywhere else on the MLS or on Zillow. So come check us out, boldstreet.ai. Yeah, it sounds like it, man. Well, there's a lot to unpack here, but Brian, I'm curious, let's just cut straight to the chase. In 5 words or less, why multifamily? Why is multifamily the investment of choice?
Because it was what I was good at. How many words is that?
Because of what I was good at. Pretty close. Pretty close.
That's almost there.
Because of what you're good at. But you did 750 flips. Weren't you good at that?
Yeah, absolutely. But, flipping is more like a job and less like an investment. If you stop flipping, you stop making money. Whereas in, multifamily, you can own thousands of units and you don't have to keep buying. You can just manage what you have and you still have an income stream. And that's not the case in house flipping. And, I'm also I'm one of these investors that believes that like the climate of real estate investing is similar to a stream that meanders through a meadow. It kind of zigs and zags. And if all you know how to do is row straight ahead, you're going to run aground. You have to be able to see where the stream is bending to and alter course to follow the current. And that's the other thing I found that I've been really good at is figuring out when was the right time to get into what and when was the right time to get out of whatever that is. And I think that's contributed a lot to my success.
Yeah, I'll say. All right. So it's funny, like you say that flipping is more of a job. All the flippers listening to the show, they're like, no, I'm an investor. I'm not have a job. You're going to get me fired from them. But I love the analogy of like needing to bend and be flexible. So what is it that you look for to figure out where you need to bend or where you need to zig or zag? What pieces of data are you looking at, and how do you come to those conclusions?
Well, a lot of it is actually just sentiment, and it's less numerically quantified than it is just a matter of listening to what people are saying and watching what people are doing. And then in a sense, doing the opposite of that. So,
okay.
So when everybody says it's a great time to be flipping houses, that's probably a great time to sell your rentals, for example.
Yep.
When everybody says it's a great time to buy multifamily, that's probably a really good time to sell multifamily. And, when we were buying multifamily, people would come up to me and say, like, how can you possibly buy something that's going to be profitable, with cap rates where they are and, this and that and the other thing. And I'm talking like 2017, 18, 19, when things were actually pretty good.
Right.
And nobody really thought this was the right strategy. And then by 2021, everybody thought multifamily is great. You got to go buy multifamily. And I'm like, excellent, because I'm going to sell all of mine right when you want to buy it all. And so I think a lot of it really is psychology and just trying to predict, where the psychology is going and making sure that, if everybody is absolutely certain about something, it's time to look at the other side of that trade.
Interesting. Okay. So we're recording this in April of 25. What are people crazed about today?
They're not crazed about much, I will say. There's a lot of hesitation, especially in the passive investing space, because people have gotten burned. There's been a lot of failed multifamily syndications in the last 3 years, capital calls, lost principal, and all these other things, mostly because they just invested at the wrong time with the wrong sponsors under the wrong structure. That's been the kind of the issue that's gotten people into a little bit of trouble. And so, again, that's the way sentiment works, right? Is when it's a really good time to be a buyer or be an investor, nobody really wants to be a buyer or an investor. So that's kind of where we are right now, is people don't really want to, put money at risk yet. This is a far better time to buy than it was 2 or 3 years ago. And it's one of the reasons why, we've made this pivot into skilled nursing, memory care, and assisted living, is because the demographics are highly supportive. It's bottoming out in its market cycle. And every segment of real estate trades at a different market cycle, and it's bottoming out in its market cycle. The basis is phenomenal. And, really people have not been that interested in this asset class. And so, again, we're taking the other side of the trade and looking like, here's a real opportunity to get in and then ride the wave all the way up. And so it's just, ride them up, but don't ride them down. That's the kind of the key to success, I think.
That's the key. Yeah. All right. So then talk to me a little bit about, like, are you buying the underlying asset or the underlying real estate that these facilities are in? Or are you actually buying the business that operates these things? Because that's, totally different than real estate, at least from the outside looking in.
No, you're absolutely right, which is why it's almost it is really two completely different businesses. There's the real estate component and there's the operations component. And generally, these are not done by the same entities. And that's the case for us. We buy the real estate and we triple net lease the facilities to highly experienced regional operators that we know and trust. And they do the day-to-day operations of the facilities. They do the licensing and the patient care and that type of stuff. So we do what we specialize in, which is real estate. And if you think about it, it makes a lot of sense, because somebody that's really good at giving patient care probably isn't really all that good at raising capital. Right? That's a completely different core competency. And so that's where we come in. We are good at raising capital because we're good at identifying opportunities. And then therefore we can step in as the real estate owner, and then the operator doesn't have to raise capital.
I love it. That statement holds true unless your name is Aaron Amin. And if you're listening, Aaron, we have to get you on the show with Brian. So we just had a guy on our show who is doing exactly what you just said. He's raising capital to go start his own assisted living facility where he's going to actually operate it himself with his wife. They have a really unique story. So it's so interesting to hear that this is kind of the opposite end of the spectrum, where you're doing the underlying asset itself. For anyone not familiar, what's a triple net lease, Brian? Bring us up to speed.
A triple net lease means that in addition to paying rent to the landlord, the triple net tenant pays everything else also. So they pay the property taxes, they pay the insurance for the real estate, and they pay for repairs and maintenance. And that's why they call it triple net, because they're basically taking care of all three of those things. And from the owner's perspective, from the real estate owner's perspective, it's a real intriguing investment because you don't have sensitivity to some of the biggest variables in real estate ownership on the expense side, which are, property taxes and insurance and repairs and maintenance. And that's been something that's been biting a lot of apartment landlords over the last, 3 to 5 years. And well, actually, since the beginning of time, it's been an issue. But especially in the last 3 to 5 years, you've seen insurance premiums doubling and tripling. You've seen repair and maintenance costs going through the roof. You've seen property tax increases and those sorts of things. And that's made apartment income streams a little less predictable. And I think right now, one of the things that a passive investor really wants is some sort of predictability. They want to be able to look at a pro forma and say, okay, I see the income that you're projecting that this is going to produce. Now I have to score the likelihood of whether or not that's actually the income that's going to be produced. Yeah. And in a triple net scenario, it's a lot more likely because those other variables are outside of the scope of the income stream for the property owner.
Yep. No, that makes total sense. So if I'm a newer investor, Brian, and I'm listening to this conversation, I'm having this light bulb moment go off my head going, oh my God, that sounds like the best thing since sliced bread. I'm going to go do triple net leases on my single family homes. Why isn't that done more?
You certainly could. There's really no reason why you couldn't, other than the fact that it's just something that the marketplace is probably not that ready to accept. If you imagine trying to place the burden of real estate insurance upon a tenant, who is intentionally deciding not to buy a home because they don't want to fool with that stuff, or maybe they're forced to be renters for other reasons, which may include their uninsurability. Trying to impose those kinds of things on that tenant base is a little more challenging than it is to say a professional operator of some commercial business, whether that's skilled nursing or a retail store. These triple net leases are very common in the retail space. Leasing out spaces to Walgreens, CVS, grocery stores, that type of stuff. Generally is done on a triple net basis, and that tenant base is geared up for the task. And I wouldn't say that all single family tenants are geared up for that task.
Yeah. All right. Well, my dreams just came crashing down. Thanks a lot.
Yeah, anytime.
So I actually own some triple net. It's been an amazing investment. And kind of like you mentioned, it's very predictable. It's very stable. Something to mention is that I think that there's a trade-off though, right? For that stability, you are probably not commanding as high a rent as you could if you were responsible for those additional expenses. Is that fair to say?
I think that's fair to say, but you also have to look at, the kind of the net income stream relative to the purchase price too. So if you're buying triple net commercial and you're buying at a 6% cap rate, that's effectively, I hate to talk too much about cap rate because it's my nemesis. I hate the term cap rate and the emphasis that's placed upon it. But in the simplest terms, a cap rate is the income divided by the purchase price. Some people define it as the return on capital that you would receive if you owned the property with no loan. And that's not entirely true, but that's a close enough kind of way to think about it. Well, a 6% return or a 6% cap rate, maybe it's not all that sexy. And I agree with that. In our sector in skilled nursing, we're buying at 10% cap rates. So, that's something that you just don't see, in any other sector of commercial real estate. No. So the general saying that, a triple net lease is going to have lower yield isn't always true. It may be true, but it's not always true.
Oh, that's awesome. Okay. Well, this is super exciting. Why don't you like cap rates?
Because they're completely misused. People get so fixated upon cap rate to the extent that they correlate cap rate to performance. And what a lot of investors don't realize is that cap rate has nothing to do with performance. One of the kind of like old topics that, I hear a lot is people will say, well, I'm going to compare cap rates to the 10-year US Treasury because, that's a risk-free investment. So, why would I invest in an apartment building at a 5% cap rate if I can go get 4.5% on a 10-year Treasury? Well, what they miss is that the 4% cap rate isn't a gauge of performance. You could earn a 20% return with a 4.5% cap rate.
Right.
So it's a little bit misleading, but people try to oversimplify the concept of cap rate to equate it to investment performance, and it throws them off. And they think, well, the deal isn't any good when in fact it is, or they think the deal is really good when in fact it's not. So I don't like it because it's misunderstood and misused.
Yeah, no, that makes sense. So when you were saying earlier that the cap rate is really not a measure of, but pretty close to a measure of what you could expect to return if you own the property all cash, what's missing from that equation?
Closing costs and upfront capital improvements. Let's say, so if you were to take $100,000 in income and at a 10% cap rate, that's a property value of $1 million, right? So people say, okay, if I invest $1 million, I get 100,000 in income. That's a 10% return. But if you buy a building for $1 million, you're not really buying it for $1 million. You're going to have maybe $20,000 in closing costs. Maybe you have to put $100,000 into fixing it up. Maybe if you put $300,000 into fixing it up, you can increase the rent by 20%. And now you're getting a lot more return on your cash than you were, just under the straight kind of 10% scenario. So it's just misleading to think that cap rate and performance are one and the same. All cap rate really is a measure of market sentiment. It's telling you how the marketplace is perceiving the value of a stream of income. And if you think of it that way, and that's all that it is, then you can use cap rate a little bit more effectively.
I love that. Yeah. Something I always talk about is like use the cash on cash return as a metric too, because that's actually a measure of how much you're putting into this deal, not just what the sticker price or the sale price is on the property. Because to your point, exactly, if you purchase a heavy value add property for 500 grand, you think, oh, I'm hitting it out of the park with this cap rate. It's like, yeah, but you put another 500 into it. So you're going to slice that in half pretty quick.
That's exactly right. And people tend to discount the impact of needed capital improvements and all other sorts of things. If you're intent on using that sort of a metric like cap rate, instead of using cap rate, use a different metric called yield on cost. Now, what yield on cost is if you take all of the costs of the real estate, the purchase price, closing costs, upfront capital improvements, all of those things, and you divide that into the income, that gives you a yield on cost. That's a little bit more of an accurate measure if you're trying to gauge performance. But I like your advice on cash return because that's what's real. That's what you're depositing in your bank account. And that's what really matters.
Yeah. Okay, great. So Brian, you've made this pivot away from multifamily. Are you kind of bearish on multifamily? Are you no longer excited by the asset class? Are you going full headlong into the assisted living?
Well, I've been known to say for about the last 2 or 3 years that multifamily is entirely uninvestable. I've been extraordinarily bearish on the asset class since we began selling, 3.5, 4 years ago. And, it's been like a falling knife. I mean, if you look at multifamily valuations in the second quarter of 2022 was when they peaked. I don't think they've quite troughed yet, but they're close. If you look at peak to trough values, I think values in a lot of markets are down as much as 40%, which is a significant haircut. And in fact, a deeper haircut than we saw in the great financial collapse, which was a bloodbath for residential real estate, but a little bit less so on the income property side. This one's kind of the opposite. This time, single family's been chugging along like, what are you talking about? Nothing to see here.
Nothing to see here.
Yeah, but the multifamily and income property side is just getting crushed. I mean, office is even worse. Office is just getting obliterated. And, in part that has a lot to do with interest rates and all that other stuff. But so I've been very bearish on multifamily. I think that we're getting closer. I think we're in a bottoming process. And I think that's exactly what it is a process. And over the course of the next year or so, we'll actually see a legitimate bottom in the multifamily market. And I'll be calling a buy at that point, maybe in a year, I don't know, maybe 2 years. I don't know. Having said that, though, there's also a needle in every haystack. And, there's deals that are out there if you can find them and you're looking hard enough. And if you find one like that really is a true needle in a haystack and not just a perceived one, then I think investing in multifamily still makes a lot of sense under the right circumstances.
I dig it. And just so we can kind of quantify for our listeners here, when we're talking about multifamily, are we talking 100 unit plus? Are we talking north of 5 units? Are we talking even in that 2 to 4 unit space? When we're talking about this, what are we saying?
Yeah, anything qualifies. 2 units and up qualifies. My specialty in the multi side is over 100 units, and that segment has really gotten crushed. Under 100 units, kind of that, I'd say 25, 30 units up to 100 has equally gotten crushed. But there's, I think, outsized opportunity in the smaller multi-space. So if you're looking for, say, duplex all the way up through 50 units, I think there's a lot of opportunity for buyers in that space right now, because this is the area where you have all of the stars aligned. You've got kind of like a really, bad market. You've got not that great of financing, but on the other hand, that smaller segment has the owners that you're looking for. It has the, quote unquote, tired landlords, the mom and pops, the heirs that inherited some rental property they don't want or know nothing about. That segment is where, actual legitimate buys can be found, versus in that 100 unit and up space, it's dominated by professional landlords, owners that do this for a living as a business. They don't have those same psychological factors that are at play, where they're willing and able to part for those assets at a price that would really make sense. They're kind of holding on for dear life, and until their lenders get a hold of the property, they're probably not a deal. But in that smaller space, I think you can find opportunity out there with the right seller in the right circumstances.
Totally. It's funny. I heard you say something very similar on the Bigger Pockets podcast a couple of weeks ago, and it kind of sparked my mind. And so I went and looked at a market in which I already own property, and I'm looking at picking up some more units, and ended up offering on a fourplex, and now have it under contract from a retired couple that's moved out of state because they're exhausted and don't want to own it anymore. So I was like, oh my God, Brian was right. So
that is awesome.
Stoked.
I'll send you my invoice in the mail.
Yes, absolutely. Absolutely. Happy to pay it. Well, that's awesome, Brian. And so I'm just curious, like you said that you've started your first fund, but is this the first fund that you've ever done, or specifically for the assisted living?
For assisted living, this is probably our, 12th, 13th. I started numbering the funds, and this is our fund number 8, but I didn't start numbering our funds until I think we had like 4 or 5 or 6 already. So we're in the double digits for number of funds that we've done, but this is the first one that we've done in the skilled nursing and assisted living space. But, thank goodness part of the thing is there was opportunity, but really this strategy was started in reverse. Because for me, it's first always about the people, and then second always then about the strategy and the timing. And in this case, I just happened to have the right person come available to join my team, a guy that I've known for about little over 25 years. We've done real estate work together before in the past, and before he got into the senior housing business 20 years ago. And he's been in senior housing for 20 years, and he was the president and CEO of a senior housing REIT. And just the right opportunities were in line for me to get him to join my team. And now we're going to crush it. Someone with that kind of experience, that's the spark that lights the flame. I'm not going to go out as a multifamily investor and go, oh, guess what? Now I'm going to go be the expert in self-storage, and I'm going to go buy mobile home parks, and I'm going to go buy senior housing and assisted living. And maybe while I'm at it, I'll buy a marina and a hotel. And that's not me. I mean, I've done almost all of those things I've mentioned over the course of my 36-year career, but I've only been successful in the ones where we've had the right team in place for that strategy. So really that's what had a lot to do with it, was the fact that I could get an industry expert veteran on my team to execute this strategy for us.
That makes sense. So I'm curious, Brian, you mentioned earlier about being able to paddle and move with the stream and bend with the stream and kind of change strategies. And you mentioned all of the things that you've done over the course of your career, some more successful than others. So many folks listening, I think, are getting either their investing career started or have a couple deals under their belt and are looking to grow either into new asset classes or grow their portfolio. how do you know like when you should just stay the course and keep doing the thing you're doing because you found success doing it versus no, actually I really need to zag and kind of go do this other thing now. I need to kind of start over and learn how to do this new thing.
Yeah, well, don't get lured into shiny object syndrome. Don't be like, hey, this is really working out. I'm crushing it. Things are going well. But you know what? I want to go buy self storages. Just because I think that's cool. Don't do that. You've got to look at what's happening in the market. You've got to look at your skill set. You've got to look at your team and stick to your core competencies to the extent that those competencies are still working. And if they're not working, this goes back to another one of my old sayings is that there's times to buy, there's times to sell, and there's times to sit on the beach. And if you've got one core skill and it's not working right now, and you don't have the team with the knowledge to try what is working in today's market, rather than going out and trying to just figure it out on your own, it might be a good time to just sit back and wait for your core competency to come back, because they always do. We stopped buying multifamily in 2021. We started selling right around that same time, and got out of 3/4 of our portfolio before the bottom completely fell out of the market. And we've done very little since then. And I would probably do very little for about another year, and then we'd jump right back into multifamily if it wasn't for the fact that, again, I had the right person come along to add to our team and found the right opportunity at the right time to execute. That's the only reason we made that switch. Otherwise, it's just, go learn how to play golf or take up a hobby or something. Don't just try to chase kind of that next great thing if you don't have the skill set for it. Because I think one thing that I think is really important, and one of the reasons I've been able to successfully raise money over decades, has been because we've never lost a nickel of investor principal. And you can only achieve that if you're very careful about what you're getting into and very careful about when to get out of those things. And that is such a valuable claim to be able to make, because when we want to raise money, even in tough times, people will trust that we're going to do the right thing because we have the track record of doing that. Counter that to somebody that's always chasing the next shiny object, that doesn't have the team with the right skill set to execute. They might go out on a limb and try something that they think is going to be cool, and then it bites them. They lose money, and now forever, for the rest of their career, they can never again make the claim that they've never lost investor money. And it's going to be more challenging for them to raise capital going forward than it otherwise would have been. So don't make things harder for yourself than you need to. Stick to what you're good at, and only flex when there's a reason to do so with the right team.
Where were you given this advice like 7 years ago, man? Because I got so over my skis on a deal doing a development thing. I got so burned that I had, because it was sexy. It was exciting, right? It's redevelopment stuff. And so I learned a very valuable and a very expensive lesson. So for anybody out there listening that's thinking about doing the big shiny object thing because it's cool, it's sexy, it's fun to talk about at parties, take Brian's advice and maybe think twice about that.
Yeah, and that's something you don't learn the easy way. You learned it the hard way, and so did I. I learned it the hard way. I was fortunate, though, that when I did learn it the hard way, I either learned it the hard way with my own money because I first tried it myself and said, well, okay, I'm going to try this new shiny object. And if it works out, then, maybe we'll raise money for this strategy or whatever. And if it doesn't work out, I lose my money, right? So I can't say that I didn't lose any of mine. I sure as hell did. Right. But I also had a couple deals where we did have investors in them, and the investments didn't turn out the way we wanted. But I just wrote them a check. It's like, hey, we lost half your money. Here's the other half. I'll take care of that. I'll take it out of my flipping profits or whatever else. It's important to have multiple streams of income so that when your primary strategy isn't working, you can do something like that. But, there had been a couple of deals where, I just bought out the investors just so they wouldn't take the loss and that I would take the loss. And part of that is also just kind of, doing the right thing and being there as a staunch defender of your investors, because, that's your lifeblood. And if you don't take good care of them, they're not going to be there for you when, you're ready for the next thing.
Yeah. Tell us real quick, high level about those deals that went sideways. What went wrong?
Well, I had an apartment deal that I bought in 2008,
Okay.
right before the great financial collapse. I thought the timing
Perfect.
was actually good though, because the real estate collapse happened in 2006. A lot of people say it was 2007, 08, 09, but it really
Yeah.
began in 2006. So I bought this apartment property. It was a 60 unit deal in Dallas, Texas. I bought it for half of what the last guy paid. I bought it from his lender, in fact, for half of what he paid.
Okay.
So I thought, okay, this is the perfect setup, right? This is what everybody talks about. You got
Right.
a good basis. You're kind of like after the market collapsed. You're buying from the lender. You're getting it at half of the last. So all that stuff just lined up perfectly. And then once I bought it, we put a lot of money into it, of fixing up units and painting the outside, new roofs, all that stuff to make it nice. And then when I bought it, I think the occupancy was like, I don't know, 70 or 80. I got up to like 98%, which all the things it checked all the boxes, all the things you're supposed to do.
Yeah.
You fill it up, you rent it out, you increase the rents, you boost the income, you do all those things. And I think I had it there for like a week. And then all of a sudden, Bear Stearns collapses, Lehman Brothers collapses. There's this whole mass catastrophe that happens, in the economy. And, 3 or 4 months later, now it's like half the units are empty and the other half aren't paying. So,
Wah, wah,
so
wah.
yeah, it's like, well, that didn't work out the way we planned, did it? So,
I did all the stuff I was supposed to. You guys screwed it up.
I did everything the book says, right?
Yeah.
So, now we're in this situation where the income from the real estate was just enough to pay the expenses, property taxes, payroll, repairs and maintenance, electric bill, water bill, all that stuff. But there was not one dime left over to make the mortgage payment. And so you have this, you're in this situation like, what do? Do you hand the keys back to the bank? Do you let them foreclose? Do you call them up and say, do you guys want this back? Do I go get money from investors? What do I do? Well, the mortgage payment was a little over $15,000. And I thought, you know what? This is temporary. It's only going to last like a month or two. No big deal. I'm just going to make the mortgage payment out of my own pocket. So I send the $15,000 to the mortgage lender. The next year or the next month, the payment comes due. I send him another $15,000. Well, I did that for 3.5 years. And
Holy smokes.
Finally, the market turned around, because that was a deep cut. The 2008 recession or the 2009 recession was a deep cut. It took a long time for these jobs to come back, incomes to come back, apartments to rent out. This is a Class C apartment building. They're the last to recover. So, just all of those things came into play. Finally, it started to turn around. I was getting to the point where the amount that I would have to feed into the mortgage was getting smaller and smaller every month until it finally got to zero. That was a really great day.
Yeah.
But by this point, I actually had more money in the deal than my investors did when you just added it all up, right?
Yeah.
And then, fast forward a year or two and the market was on fire. And, I decided, okay, this is the time. So put it on the market, sold the property, got all the money that I put in back, got all the investors' money back, and even made about some small mid-single digit return for the investors, which was an absolute win. And it was so fun because I got to call up the investors and go, I haven't sent you any money in like 7 years, but I need your wiring instructions because I've got to send you your entire investment back plus a profit. And they're like, what are you talking about? I wrote that off years ago. And I'm like, well, that's your first mistake, is don't ever write it off when you're investing with me.
Wow. So doing like the rear view mirror look, what would you have done differently? Obviously, we couldn't have predicted the financial crisis. What did you do wrong?
What I did wrong was I let the lender finance the whole project. So the lender was so desperate to sell it that they said, look, the loan balance is almost twice what I was paying for the property. So they said, what we'll do, we'll keep the existing loan in place. We'll write off the balance so that the outstanding balance will be equal to your purchase price, which essentially gave me 100% financing. All I had to do with my investor money was cover all the closing costs and capital improvements and that sort of stuff. So I was just too levered. And that was really the big mistake. If I had it to do over again, if I went into that deal with like a 60% LTV loan, I wouldn't have been completely out of the woods, because still there was no money left for any mortgage at all, even a smaller one. But certainly what I would have had to come out of pocket with would have been significantly less if the loan was half the size that it was. But that was my greatest lesson, was twofold. One is always be mindful of your leverage. And the second is never underestimate the power of an economic recession. And that's another reason why, I'm not, all that gung ho right now, and being very careful about what I buy, because there's a reasonable chance that there could be a recession. And, and that could be painful. And, I'm too old for that kind of pain anymore. That's for younger cats to go figure out. I'll just, take more of the easy road, and I'd rather do nothing than, get extended. That's just me and where I'm at in life right now.
No, that's great. That's great. Because I think had people had that advice a couple of years ago, especially a lot of these multifamily operators, they were kind of looking around going, oh, well, this isn't like 2008. This is way different. Times are different. Let me just go lever up to the hilt with floating rate debt because it's at 2%. This is awesome. And then tide went out and we found out, hey, a whole lot of those people were swimming naked.
There's no doubt. And, when you look at a lot of the real estate transactions, especially in large multifamily that took place between 2019 and 2023, they were in a lot of cases very highly levered, sometimes as high as 90% loan to purchase price, just a lot of leverage. And that's what's causing a lot of damage. And it's interesting because I'm doing a presentation at a conference coming up in a couple weeks for passive investors. And I'm doing a 2-hour workshop on selecting passive investment opportunities.
Oh my gosh.
In connection with my preparation for this talk, I've been collecting failed syndication deals from, this large group of people I've reached out to and said, if you've ever lost money in the last couple of years on any of these deals that you've invested in, I want to know about it. And I want to see the original sales deck that was presented to you, because I want to deconstruct these deals and look for commonalities and like, what kind of things can I find that maybe would have been red flags or warning signs that would have prevented you from investing in this deal at the time. And it's been a very interesting exercise, because this week has been the time I set aside to study all of these case studies. And there's been a couple of commonalities. And one is almost every one of them was acquired in 21 or 22. That's one commonality. Another commonality is every one of them was acquired with some type of short-term financing that had maybe a 3-year or 5-year loan maturity. And or a bridge loan component. And I've also asked people to send me deals that have been successful and look at what are the differences, so I can compare and contrast, so the successful deals had longer term financing, much more conservative leverage, 60%. They were generally bought, in 2019, 2020, and 21, not late 21, 22, 23. But even one that was bought in late 21 or early 22 is performing just fine, because it was bought with low leverage, long-term fixed rate debt. And so, it wasn't suffering from some of the same challenges that we're seeing in a lot of the other multi-deals. So it's, just one more piece of evidence that leverage is important. Timing is important. People say, oh, well, is timing of the market or time in the market?
In the market.
Yeah. And it's like, timing is a lot of it. Time in the market there's nothing wrong with that, but you don't have time in the market if you have a 3-year bridge loan. There's a defined period where you must take some sort of action, either by selling or refinancing. That's not a time in the market strategy. So you can't say you can't say I'm investing by time in the market and finance it by timing the market. That just doesn't work.
Oh, that's so good. I'm curious, were some of the other common threads for the failed deals, it continued assumed 15% rent increases and assumed cap rate compression at the exit?
Well, they certainly were assuming cap rate compression, or at least the leveling of cap rates, but leveling at a 4.5% cap rate, which just made absolutely no sense at all. That was very common. Another common thread was inexperienced sponsors and people that have never seen a market cycle. And the successful deals, the ones that I've looked at, all were with sponsors that had survived a previous market cycle, which probably influenced their approach and was why they didn't buy with that shorter term debt. And, we still have 1,000 units in our portfolio and it's all on 10-year debt, which is the reason why, we're not panicking of like, oh my gosh, we have to refinance, and that's the situation a lot of owners are finding themselves in. And in fact, they're doing capital calls to investors so that they can try to negotiate loan maturity extensions. So give us another year and we'll have this all sorted out. And that may not turn out the way they think.
Damn. All right. Well, Brian, one last question before we get you out of here. And it's a real softball question. Where are interest rates going in the next 6 to 12 months? Oh yeah, that's a softball as they come right there. Well, let me just pull out my magic 8-ball and shake it up and turn it over and see what it says. I actually think, I've been waffling on this a little bit because 6 months ago I said I think rates are going to be higher for longer. That was really my thought. Now with all the tariff talk and and all this stuff, there's a reasonable chance we could find ourselves at least in a mild recession. And I think that there's some pressure, right now there's pressure on stocks just in the last couple of weeks, which I think will end up putting pressure on the bond market, in a positive way where people are going to move more towards bonds, which may bring the long rates down a little bit. I think we have a Fed chair that's completely out of touch with reality and really has his finger off the switch. I think he should have lowered rates a while ago. It's creating severe damage in the commercial real estate space the longer this goes on, which on one hand, I'm kind of glad about because it's going to breed some opportunity in 6 months to buy some really great deals. But on the other hand, it's injuring people that don't need to be injured. So I think that rates may come down a little bit over the course of the next 12 months. That's my thinking right now based on what I see. But I could very easily be wrong and rates could go up despite all of the stuff that, I think is happening out there right now. Clear as mud.
Yeah, that's the way it is with interest rates. Ask me what the Dow is going to do. I'll probably give you a similar answer.
Yeah. Yeah. Brian, this was awesome, man. I want to get you out of here and be respectful of your time. If people want to reach out, learn more about you, your investing, your funds, what you're doing there, where's the best place for them to do that?
Our website. It's Praxis Capital. The website is praxcap.com. It's praxcap.com. You can also find me on Instagram at Investor Brian Burke. You can find me on the Bigger Pockets forums answering questions, or like you heard me on the Bigger Pockets podcast. I'm sure I'll see you around at a conference or something somewhere along the way as well.
Absolutely. Well, good deal, Brian. Thanks again, man. We'll definitely be in touch. Take care.
Thanks for having me.
All right, everyone. That was our show. A big thank you to Brian for coming on. As always, we love ratings, reviews, comments, questions, and we look forward to seeing you on the next one. Happy investing.